Qualcomm has been one of the early winners in the artificial intelligence race. Although the company lost a key customer in China due to restrictions, the company's business has been expanding nicely with innovative new products in new categories like personal computers and automotives. So, understandably, investors are interested in Qualcomm stock. But what's a fair price to pay? What's the valuation worth? That's the question I'm going to answer in this video, doing a discounted cash flow valuation of Qualcomm stock to let you know what I think is a fair price to pay for this excellent AI stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So three of the numbers I'm going to need as inputs for my valuation model are the company's market cap, which stands at 178 billion, down from close to 250 billion in the middle of the year. The cash balance at 7.8 billion, and the company's total long-term debt at 14.63 billion. I also need the number of shares outstanding, which are 1.13 billion, and I need Wall Street analyst estimates for the company's free cash flow over the next several years, starting with 2024, which finished the year at 11.16 billion. It's expected to rise to 12.3 billion in 2025, up to 14 billion in 2026, before falling slightly to 13.6 billion in 2027, and then rising again to 16.5 billion in 2028 and 18.7 billion in 2029. Remember, these are Wall Street analyst estimates for what they expect the company's free cash flow to be over these next several years. These are a collection of the Wall Street analysts that are following the stock and the average numbers of those analysts that are following the stock. So they all give their inputs, and those inputs are aggregated into averages for these years in free. I also need the company's beta, which according to Yahoo Finance stands at 1.29. So now that we have all the inputs, we can jump into our discounted cash flow valuation model. And this was as of December 18th, 2024. Starting with this number here at 11.16 billion, you can see all of those estimated free cash flows from Wall Street analysts all the way up to 2029 number of 18.67 billion. If you take the growth rate of these cash flows between 2024 and 2029, you'll find that they increase by roughly 11.2% if they are following these guidelines and if they do indeed come in as expected. Between the years 2030 and 2034, I'm forecasting that Qualcomm's increase in free cash flow will decrease by half to 5.6% and then settle down to the longer-term growth rate in free cash flow from 2035 to infinity at 5%. So all of those free cash flows estimated between 2024 and 2035 are growing, but then slowing down. And that's expected. That's what usually happens with as companies grow larger. Their increasing rates of cash flow slow down and settle down to the longer term growth rate of GDP. Now, because these are cash flows expected in the future, I need to discount them back to today. I need to bring them back to today to find out how much they're worth today. And we can do that easily enough using the weighted average cost of capital as the discount rate. Because money in the future is worth less to us than money today, we use a cost of capital to discount those cash flows. And the weighted average cost of capital I used was 11.5%. Using a cost of debt of 7.5%, a capital asset pricing model cost of equity of 11.94%, applying a beta of 1.29 and a risk-free rate of 4.2%, which, by the way, I may need to adjust my risk-free rate upward following the Fed meeting today, where the central bank signaled that it's not going to lower interest rates by as much over the coming months and over the coming years, and that sent interest rates higher by roughly 10 basis points already in the early reaction. I'm going to wait to see where the 10-year Treasury yield settles down before I make any adjustments to my risk-free rate, but I wouldn't be surprised if I have to adjust my risk-free rate higher as a result of the Federal Reserve, the central bank's meeting this morning. So the market risk premium I'm keeping at 6%. The company's market cap is at 178 billion. And since it has total debt of 14.6 billion, I've applied a target capital structure of 10% debt and 90% equity. So when I discount all of its future cash flows back to today, I get a value, the present value of all of those cash flows that it's expected to earn at $233 billion. Okay, that's the value of all of the cash flow. But to that total, we need to add the company's cash and subtract the company's debt. And that brings us to a value of equity of $226.459 billion. But we want to know what's the price per share, not just the price for the company's equity overall. And so to do that, we divide it by the number of shares outstanding. And that brings us to an intrinsic value per share of $200 for Qualcomm stock. Now, interestingly enough, the current market price is only $158. So according to these inputs and this calculation, the intrinsic value per share for Qualcomm is much higher than the current market price, which signals that it's undervalued, signals that investors are getting a good deal at the current market price for Qualcomm stock. But remember, I used a lot of estimates and assumptions to make this calculation. So I could be using numbers that are too high or numbers that are too low. Maybe the stock should be worth even more. I want you to consider all of those before you make a decision on Qualcomm stock. Perhaps create your own discounted cash flow model and change some of the inputs that I've used to your liking, to something that you feel is more accurate. Or maybe you feel that the numbers are accurate, but you want to get more information on this company before you make a decision. And thankfully, I have dozens and dozens of videos on Qualcomm stock on my channel. I encourage you to watch at least a few more videos on this company before jumping to any conclusions. The discounted cash flow valuation is just one of many valuation methods to use, and it's only one step in my 6-step framework for evaluating stocks. So all of this points to the fact that this information alone is not enough to make a decision to jump to the conclusion and say, okay, it's undervalued. I should just go out and buy because that's what Parkev's calculation said. Please exercise more caution when evaluating and making decisions on stocks. Don't base your decisions just on one point of calculation. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.